Investors lost trillions. Homes vanished. Main streets emptied. We remember 9/11, the Cold War, but the greatest financial catastrophe of our lifetimes? It happened. It broke the world. Yet, its blueprint was drawn by a handful of men in towers, fueled by ambition, greed, and a system that allowed them to gamble on the dreams of ordinary people. How did it happen? Was it an accident, a crisis, or a deliberate act? Today, we uncover the chilling narrative behind the scenes. A story of collusion, innovation built on risk, and the catastrophic consequences engineered by those at the top. This is the story of the banking cartel that designed the 2008 crisis. It wasn't spontaneous. It began years earlier in the roaring 2000s. Low interest rates, a booming economy, and a belief that housing prices only went up. Banks, needing to make more money, turned to a seemingly endless supply of mortgages, even risky ones. This was the subprime mortgage market. But they didn't stop there. They packaged these risky loans into complex, opaque financial products called mortgage-backed securities, MBS, and collateralized debt obligations, CDOs. Think of them as layers in a giant casino built on other people's homes. The top layer was safest, cheapest for investors. The bottom layer, well, it ate the bad loans. But who put the most toxic stuff there? The answer? The big boys. The too big to fail banks. JP Morgan Chase, Bank of America, Citigroup, Goldman Sachs, Morgan Stanley. These weren't just competing. They were designing the game. They pushed the riskiest products, betting they'd be bailed out if it all went wrong. This wasn't just finance. It was a system rigged for disaster. So how did it actually work? Imagine a massive, multi-layered bet. This is what selling CDOs was like. You'd buy a piece of a CDO, a tranche. The top tranche was like the safest seat in the house. You paid a little for it. The bottom tranche was high risk, high reward, like sitting at the bar betting the bar tab. The middle layers, that's where the big players, the cartel members, put the real risk. They took the dregs, the toxic sludge from the bottom, and layered it in the middle, selling it as safe. It was a pass-through system. Each tranche was backed only by the underlying mortgages. If a mortgage defaulted, the loss trickled down, starting from the bottom. But the big banks engineered this complexity. They could sell off the safe parts cheap, hoovering up capital, and then hold the toxic middle layers. They designed the system to concentrate risk where they were safest, while extracting fees from the entire process. Selling these complex wagers wasn't selling risk. It was selling structured safety, and they collected a commission either way. And crucially, they operated in an auction market. Investors weren't just buying from the banks. They were competing against each other. This meant someone had to sell the riskiest parts. Who wanted the bottom layer? The CCC tranche? It was sold at a discount. Who bought it? Often it was hedge funds, money market funds, or even other parts of the same big bank, betting they could be right. Or it was sold to the cartel itself, reinforcing their position. Finally, the moral hazard. The banks knew they were creating a ticking time bomb. They knew these complex products could unravel if the housing market collapsed. But they also knew the government, the FDIC, was there. They knew that if the Titanic sank, they wouldn't be allowed to sink the ship too. They'd be bailed out. This knowledge wasn't accidental. It was baked into the system. It was the ultimate incentive to push risk, because the downside was guaranteed protection, while the upside was massive fees. The design finally failed. The housing bubble popped. Subprime loans started defaulting in record numbers. The domino effect began. It started small, with Bear Stearns needing a bailout in March 2008, a panicked $3.1 billion lifeline. It was the first clear sign that the cartel's engineered disaster was real. As defaults mounted, the value of the underlying mortgages plummeted. This meant the entire structure collapsed. The top-rated AAA tranches, supposedly the safest, started losing value dramatically. Investors panicked. Credit markets seized up. It was like the entire financial plumbing stopped working. No one could trust the value of anything. Banks were leveraged hundreds of times over. A small default could trigger massive losses. These losses threatened to bring down the biggest institutions. The cartel's gamble had become a nightmare. They had built a house of cards, and the wind was blowing. The final, catastrophic moment arrived on September 15, 2008. Lehman Brothers, one of the pillars of the cartel, imploded. It was a shockwave. The world watched in horror as the unthinkable happened. The government stepped in, but not with a clean solution. It was the Troubled Assets Relief Program, the $700 billion bailout, a staggering admission that the system was broken, and the cartel itself was too big to let fail. It was the ultimate consequence of their engineered crisis. The consequences were global. The 2008 crisis triggered the Great Recession, the longest and deepest since the Great Depression. Millions lost their jobs. Millions lost their homes. Businesses collapsed. Global trade plummeted. The world economy teetered on the brink. Who paid the price? Everyone. Taxpayers through the massive bailouts and TARP funds. Savers as bank deposits became less safe. Borrowers trapped in underwater mortgages. And homeowners facing eviction and foreclosure. The cartel, ironically, was bailed out while millions were wiped out. Out of this disaster came new regulations like Dodd-Frank, an attempt to prevent a repeat. But were they enough? Critics argue the cartel simply adapted, hiding their risks in new, complex vehicles, still protected by the implicit guarantee of being too big to fail. The moral hazard remained. Wall Street paid a price, but it was steep. Bonuses soared again almost immediately after the crisis passed. The bailout bonuses became a symbol of the system's brokenness. Did they learn? Or did they just find a new way to engineer the next crisis? The story of the 2008 crisis isn't just about greed. It's about collusion. It wasn't just greedy bankers. It was a system designed by them, allowing them to concentrate risk and guarantee reward. It was a conspiracy of silence, of complex language hiding deadly flaws, of regulators asleep at the helm. The lesson? Financial systems are fragile. Complexity can be a shield for greed. Power without accountability is dangerous. And the belief that certain institutions are untouchable is a recipe for disaster. The cartel didn't just cause a crisis. They designed one, and they knew it. What if the biggest risk today isn't inflation or recession or even AI? What if it's the echo of 2008? The potential for a new crisis engineered by the same forces, just with different tools. What questions would you ask the leaders of the cartel if you could? This is just the beginning. The story continues. To explore more, subscribe, and join us as we continue to investigate the forces that shape our world.